Today, we're going to learn about inflation. That is, money loses its value. Things cost more. We'll look at why inflation happens and how we can deal with it. Today, I'd like to introduce Happy Consultant again.
Inflation is a situation where there is too much money around. It's like when an apple that cost $1 yesterday becomes $2 today. However, inflation is essential for economic growth. Without it, businesses struggle to expand. You might think it would be good if an apple stayed $1 forever. However, if the price stays the same, people will keep waiting and delay buying apples. If an apple is $1, is there really a need to buy it today? That is the true question. Also, if the prices of products always stay the same, producers' income will remain constant. Then, people will lose their motivation to work, profits will be frozen, and the whole economy will lose its energy. A little inflation helps the economy grow. However, too much inflation brings big problems. It erodes your savings and makes things unaffordable. If an apple that cost $1 yesterday becomes $2 today, people are likely to buy it quickly for $2 because they think it will be $3 next year. Then, prices rise faster than people's wages, which becomes a significant burden on their finances. Also, if prices get too high, people lose their motivation to work again. Therefore, the government wants a moderate level of inflation, at a level that doesn't hurt workers' motivation to work. This number is not exact, but you can think of it as about 2%.
Dr. Happy is saying that inflation is essential for economic development. I see. Thank you for the good explanation. So, how should ordinary people deal with this inflation?
Above all, asset allocation is important to prepare for inflation. First, you need to look closely at interest rates. Generally, it's good to hold stable US Treasury bonds. And most importantly, it's good to hold a certain amount of US stocks. US stocks have given a return of over 8% for the past 100 years, excluding the period from the 1970s to the 1980s, when 10-year US Treasury bonds yielded over 8%. US stock returns were always higher. Therefore, the very first thing is to hold high-yield US stocks for a long time.
Since 1970, the investment landscape has shifted. The S&P 500 has significantly outperformed other assets, beating corporate bonds by almost threefold.
Thank you, Dr. Happy. To summarize, you said the most important thing to defend against inflation is asset allocation. And you are saying that investing in the highest yielding US stocks is the best option. Inflation is the biggest enemy of capitalism. It would be a truly sad thing if the money you saved just disappeared. Thank you, Dr. Happy, for all this information. I look forward to learning more from you in the future.